Level 1. Overdraft and negative balance. Your account is negative. Maybe by $4, maybe by $400. The number almost doesn't matter because the system that responds to it doesn't care about the size. It simply activates. The overdraft fee hits within hours, $35 at most institutions. Some banks charge it per transaction, which means if 3 small charges go through while your balance is negative, you owe $105 in fees, on top of whatever deficit you were already carrying. The math of this is almost elegant in how precisely it punishes the wrong person. If you had money, you wouldn't be overdrawn, but because you don't, you now have even less of it. You try to use your debit card at the gas station. It declines. You try again. It declines again. There is a line behind you. You are doing arithmetic in your head that you cannot finish fast enough, and the card is still declining, and everyone is watching. This is what financial stress actually feels like. Not dramatic, not cinematic. Just a card declining at a gas station while you try to calculate whether you transferred enough yesterday to cover this. The bank offers you overdraft protection. What this means in practice is that instead of declining the transaction, the bank will cover it and charge you $35 for the service of not embarrassing you at the gas station. Some banks have moved to smaller fees or eliminated them entirely under regulatory pressure. Most haven't. The ones that remain are disproportionately used by the people who can least afford them. Banks collected over $7 billion in overdraft fees in a single recent year. The majority came from a small percentage of accounts, chronically overdrawn, the same people, paying repeatedly, for the privilege of being poor in a system that charges for it. You cannot get a credit card here. You cannot get a loan here. You cannot get flexibility or patience or a phone call from someone who actually wants to help. What you get is automated. A fee assessed by a system that does not know your name, does not know you were overdrawn because your paycheck was delayed by 2 days, does not know that the $47 charge was a gym membership you forgot to cancel 6 months ago. The system knows one thing about you. Your balance is negative. Everything else follows from that. You are not a customer at this level. You are a cost the bank is trying to recover. Level 2, low balance. You pulled the account back from the negative. You have $200, sometimes $400, occasionally $600 before the rent goes out and it drops again. You are not overdrawn. You are something slightly better than overdrawn, which is to say you are in the category of accounts the bank services but does not particularly value. The monthly maintenance fee arrives, $12 or $15, automatically withdrawn because your average daily balance did not meet the minimum requirement. The minimum is usually $1,500, sometimes $500, depending on the institution. If you had $1,500 just sitting untouched in your account, the fee would disappear. But because you don't, it stays. You are paying for the account that is supposed to be holding your money. The account is basic, checking or savings. No special rates on the savings because the balance is too low to qualify. You are earning 0.01% annually on whatever sits there, which is roughly nothing. Well, the bank lends that money out at 7 to 24%, depending on the product. The spread between what they pay you and what they earn from your deposits is how banking works at every level. At this level, you are simply not large enough for them to compete for your business. You try to apply for a credit card. You might get approved for a secured card, which requires you to deposit money as collateral against your own credit limit. You are lending the bank your own money so they can lend it back to you and charge you interest for the privilege. This is legal. This is normal. And this is how credit is built when you are starting from the bottom. The service you receive is not hostile. It is indifferent. The teller is polite. The app works fine. If you call with a problem, you wait on hold and eventually speak to someone reading from a script who can solve standard problems and escalate non-standard ones to someone you will never speak to. There is no relationship here. There is a transaction. You need basic banking services, and they provide them. That is the entire extent of it. You are a number at this level. Specifically, you are a small number. And the bank's interest in small numbers is purely automated.
Level 3. Stable income. Something changes. Not dramatically, but it changes. You get a better job, or the job you had starts paying better. Your direct deposit is now $3,200 a month, and it hits every 2 weeks without fail. The bank notices, not with a phone call, not with congratulations. It notices algorithmically. The pattern of your account shifts from irregular and low to consistent and moderate, and the system responds by moving you into a different category. the credit card offers start arriving. Not the secured card, actual credit cards with actual credit limits of $2,000, maybe $3,500. The interest rates are still high, 22 to 26%, because your credit history is short and the bank is still pricing risk. But the door is open now. The institution that had nothing to offer you 6 months ago is now mailing you things and showing you banners inside the app. The product suite you couldn't access before is suddenly being pitched to you because your income pattern has made you a viable revenue source. You apply for a small personal loan, $5,000, car repair. Approved in 48 hours. The rate is 11%. Not great, but manageable. What you notice is that the process worked. You needed something. You applied. You were approved. For the first time, the bank functioned the way banks are supposed to function in the stories people tell about banks. The monthly fees have likely disappeared because your direct deposit now qualifies you for a fee waiver. This is a small thing that feels larger than it is, because you are paying those fees long enough that their absence actually registers. You are a customer now, recognized, serviceable. The bank wants to keep you because you are generating revenue through your card usage, your loan interest, and your growing balance. You matter to them the way a customer matters to a business, which is to say, you matter as long as you're spending, and you'd be replaced without ceremony if you left. Level 4. Growing savings. You have been consistent, not lucky, not dramatic, just consistent. The savings account has $18,000 in it. The investment account has another $22,000. The credit card gets paid off every single month, so the 24% interest rate is completely irrelevant because you never carry a balance. You have built, through ordinary discipline over several ordinary years, a financial profile that looks meaningfully different to a bank's risk models than it did 5 years ago. The credit limit increases start happening without you asking. You log into the app. The limit has gone from $4,000 to $9,500, then to $14,000. The bank is extending you more rope because your history shows you don't need it. You pay on time. You don't max out. You are a low-risk, high-engagement customer. The loan rates get better. When you buy a car this time, the bank offers 6.8% instead of 11%. Not because they like you more as a person, but because your credit score and your asset profile have shifted the risk calculation in your favor. The price of money is lower for you now because you have demonstrated that lending you money is safe. This is how wealth compounds through the banking system, even before the wealth is large. Better rates mean you pay less for the same things. Paying less for the same things means more capital stays in your hands. More capital in your hands builds faster than less capital does. The system begins to tilt in your favor, slowly, quietly, at the level of basis points and approval rates. If you walked into a branch and said you were considering moving your accounts, someone would likely attempt to retain you with an offer. That is a different experience from the automated indifference of level 2. It is not intimacy, but it is the beginning of leverage.
Level 5. High savings and assets. Your combined assets are north of $150,000. Savings, investments, and the beginning of a retirement account growing faster than you expected. You are not rich by the standard of what comes later, but you are in the top tier of what most retail banks see on a daily basis. And the treatment reflects that. The phone line is different now. There is a priority queue for customers at your asset level. Hold times are shorter. The person who answers is more senior. They have more authority to waive fees, make exceptions, and approve things without escalating. When something goes wrong, and something always eventually goes wrong, the resolution is faster because the person handling it actually has the tools to fix it. A dedicated banker is sometimes assigned, not at every institution, but at the better banks. A named contact, someone who knows your account, emails you directly, calls to check in. It sounds like a relationship, and in some ways it is, though the relationship exists inside a commercial frame. They are attentive because their performance is measured partly on the retention of accounts at your level. Understanding that doesn't make it less useful. The access is real regardless of the motivation behind it. Pre-approved products start arriving. Mortgage pre-qualification, investment products, premium credit cards with real rewards instead of the 1% cashback that lower-tier cards offer. The institution is beginning to compete for your future business, not just your current balance. You are a preferred client now, named, known, flagged in the system as someone worth protecting. Level 6, high net worth. Generally begins somewhere between $500,000 and $1 million in investable assets.
At this level, the bank stops being a place you visit and becomes a service that comes to you. Wealth management is offered, financial planning, investment advisory, tax coordination, estate planning guidance, all wrapped into a single relationship. The quality varies by institution and by the specific advisor assigned. Some are exceptional, some are expensive salespeople with good suits. You learn to tell the difference quickly because the difference costs money. The conversations change texture. You are no longer being sold consumer products, you are being consulted. Someone is asking about your goals, your timeline, your risk tolerance, your family situation. The motivation is commercial, the experience is personalized. Both things are true at the same time. Loan approvals move faster, the paperwork is lighter, the rates are better. When you call about a wire transfer that has gone sideways or a fraud alert that has frozen an account you need access to immediately, the problem is resolved in the same conversation. No callbacks, no escalations, no scripts. Someone with actual authority handles it in real time because your account warrants that level of response. You are an asset to the bank now, not a customer, an asset. The language in the internal system is different, the protocols are different, the experience is different. And the distance between this and level 2 is not a matter of better service. It is a different institution operating inside the same building.
Level 7, very high net worth. Above $5 million in assets, the bank begins offering things that are not publicly advertised, products that don't appear on the website, rates that aren't posted on any board, access to investments not available to regular customers because they require accredited investor status, minimum commitments, or a relationship history that most people will never have. The interest rate on your mortgage is lower than what anyone in level 3 would ever be offered, not slightly lower, meaningfully lower, by enough over the life of a loan to amount to tens of thousands of dollars in difference. Your advisor at this level is not a generalist. They are a specialist, possibly a team of specialists. One handling investments, one handling tax strategy, one handling estate and trust structures. They coordinate, they communicate, they meet with you quarterly in a room that doesn't look like the room where level 2 customers wait. The room has better chairs, and the conversation has different stakes. What special treatment actually means at this level is that the rules governing retail banking, the minimums, the waiting periods, the approval timelines, the fee structures, the access restrictions, apply differently to you. Not because the laws are different, because the bank's internal policies have discretion built in, and that discretion is exercised in favor of accounts that generate significant revenue. Level 8, ultra wealthy. Private banking is a different product from wealth management in the same way a charter flight is a different product from first class. They both get you there. The experience is not comparable. At this level, you do not have a banker. You have a private banker. This person manages a small number of relationships, sometimes fewer than 20, and their entire professional focus is on those relationships. They know your children's names, they know about the foundation, they know what you are trying to build and what you are trying to protect, and they have direct access to the decision makers inside the institution who can make custom arrangements that no standard product menu would ever capture. The deals at this level are bespoke. The interest rate on a loan is negotiated, not published. The investment minimum for a private equity co-investment is waived because the relationship justifies it. The documentation required for a transaction that would take a regular customer 2 weeks to complete is handled internally in 48 hours because the people processing it have been told whose account this is. The rules become flexible. That sentence requires honesty about what it means and what it doesn't. Banks do not break laws for wealthy clients. What they do is exercise every legal degree of discretion available under their policies in favor of clients whose relationships are worth preserving. Fees that technically apply are routinely waived without being asked. Exceptions that require manager approval are approved before the manager is even formally consulted. The system that was automated and indifferent at level 1 is now human, attentive, and oriented toward yes. You are not a client at this level. You are a relationship. The institution's relationship with you is a named line item in someone's performance review. Losing you would matter to people whose careers depend on not losing you. That is a different kind of power than anything else in this conversation.